So before we jump into an example, let's think about sort of what are the things that we need to consider and how what types of scenarios are we going to encounter where revenue is going to be recognized over a period of time, because that is how the performance obligation is satisfied, not at a single point in time but over a period of time. Usually, what we see is a situation where the customer is consuming the benefit of our services and products over that period of time. So, anytime you're talking about a service organization, so a lot of times in financial accounting, we talk about a landscaping company or a consulting firm, right? A cleaning service, an accounting firm, right? Providing services to their customers. That benefit, that service is being provided over a period of time. The customer is consuming that benefit over that period of time, and so that is how we have to recognize revenue, right, as the performance obligation is being satisfied over that period of time. We're also later in the lecture going to go through some more complex examples when we are actually building an asset for a customer. And so that's where the scenarios 2 and 3 are included, where we're building this asset and either the asset is controlled by the customer over the period of time that we're constructing it, or the asset has no alternative use other than the purpose for which we are building it for this particular customer. In each of those instances, we may be able to recognize revenue over the period of time that we're constructing the asset. And again, I said we may be able to recognize revenue over that period of time. We're going to go through again a few examples where we have to decide whether we need to wait till the full construction is done or we're allowed to recognize revenue over the period of time that we're constructing the asset. But in each of these scenarios, what we have to determine, right, is how much of that revenue needs to be recognized and sort of spread out over the time period that we're satisfying the performance obligation. Uh, I mentioned, right, so for the construction of an asset, that's a little bit more complicated, especially when it's in the form of a long-term contract. So something that's going to take more than a 1 year period of time. But for this first scenario, right, this is going to be something that's familiar to you from financial accounting, because in financial accounting, we went through a few different examples where a customer was receiving services over a period of time, and we then recognize revenue over that period of time. So that's where this example sort of comes in. So our company, in addition to selling those Tribox gaming consoles, our company, we're going to assume, also sells subscriptions to a multi-user platform. So basically, we are allowing our customers to utilize this platform to play internet-based games on our console. So we have to decide how we would go about accounting for these two different transactions that we see listed here as it relates to the sale of these subscriptions to customers. So on January 1st, our company is going to sell 1,000 subscriptions that were worth $60 each, and we're going to receive the full amount in cash on January 1st. And then we have to figure out, okay, after 1 month has gone by, right, of this 1 year subscription, how would we go about sort of adjusting our accounting for that 1 month of the annual subscription that's now been used by our customer? So in our Excel spreadsheet, if we toggle over to the second tab, here's all of the information for that particular problem. And so we have to first, I'm going to calculate over here, right? How much is this total transaction going to be worth? If we take the 1,000 subscriptions, multiply them by the $60 price per subscription, that's the total amount that this transaction is worth. And we said that on January 1, when we sell all 1,000 of those subscriptions, we actually receive cash immediately. So on January 1st, we're going to see in our journal a debit to cash for the 60,000. And then we're going to see a credit, not to revenue, right? Because at this point in time on January 1st, we have not satisfied any of our performance obligation. Our performance obligation is to provide access to this multi-user platform over a year's worth of time. So on January 1st, when we get that cash in our pocket, we haven't done anything to earn it. So we're going to call that unearned, or sometimes it's referred to as deferred revenue. Either term can be used. And that unearned or deferred revenue, we remember from financial accounting, is actually a liability account. So it represents a service that we still have to provide to our customer. Then on January 30th, again, 1 month of that subscription has now been used by these customers. So we get to recognize 1 month worth of that revenue. So if we think that the full value of the contract, right, 1,000 times the $60 is $60,000, we then need to figure out what would 1 month of that contract revenue be worth. So I'm simply going to take the 60,000, I'm going to divide it by 12, and that gives me 1 month of contract revenue, right? So on January 30th and at every subsequent month following, what we would see is a debit to unearned revenue or deferred, again, if you used deferred, for $5,000. And then the credit is going to be to subscription revenue or whatever we can sort of label it to make sure that we understand what kind of revenue this is, right? Because the previous example, we had sales revenue when we sold the actual gaming console. Now we want to be specific as to what type of revenue this is. It's going to be subscription revenue, or some, relatively similar term. And again, the credits for 5,000. So we're able to see that at every month end, this is the entry that we would make in our accounting journal, such that after 12 months have gone by, we should see a zero balance in that unearned revenue account, right? Because after the full year has gone by, we will have satisfied our entire performance obligation, and therefore we wouldn't have any liability for the unearned revenue anymore. So this is, again, a very simple example where we have gone through, still one single performance obligation, but we're recognizing revenue over the period of time that we're satisfying that performance obligation. That example that we just went through was an example of output-based estimate of how we can go about allocating revenue over the period of time that we've earned it. So we were looking at the output of the subscription being used by our customer, right? That was giving us an indication of how much revenue we should recognize over time. We also can use input based, and that's where we're sort of assessing the effort that we have put into the satisfying the performance obligation. That's more what we're going to see when we go through the example of a long-term contract, because we're going to be able to see, okay, how much of this build, right? If we're building an asset for our customer, how much of this build has been accomplished at any given point in time? How much input, right? In terms of materials, labor, how much input has gone into the construction of this asset, and therefore how much revenue can we account for based on that input. So we can do it either way. In our very simple example, though, we were measuring based on the output, right? How much of that subscription had actually been used by the customers over that period of time. And now, just to reiterate, if we are not able to see that any of those three criteria, if I go back up to slide 9, any of these criteria have not been met, then we simply have to allocate all of the revenue at a single point in time. And that point in time is usually going to be at the end of the contract. So if we're not able to establish that the customer is consuming the benefit over time, if we're not able to establish that the customer has control of the asset over the time that we're constructing it, or that the customer is the only one that's going to be able to utilize that asset, if we can't confirm any of these three things, then what we would have to do is wait to a single point in time to recognize all of the revenue associated with the performance obligation. And again, that point in time is usually going to be at the end of the contract period. And you're going to see that when we go through the examples of recognizing revenue for a long-term contract. There's going to be a scenario where we're able to say, okay, because the customer actually has control of the asset over the time that we're constructing it, yes, let's go ahead and recognize revenue over the period of time that we're constructing the asset. And then we're going to go through another scenario where no, the customer actually doesn't have access to the asset. They're not consuming the benefit over the period of time that we're constructing the asset. And that asset has alternative uses other than just what our customer is going to be using it for. We're not able to establish any of those three criteria. Therefore, we cannot recognize revenue until the contract is over, until we've satisfied the entire performance obligation. So we'll go through those examples in later on in the lesson. So, just to kind of lead us to where we're headed in terms of revenue recognition, we've gone through the examples where we've had a single performance obligation, one where we recognize revenue at a single point in time, and then another where we recognize revenue over a period of time. What we're now going to move into in the future examples is where we have multiple performance obligations, and you see that then creates a little bit more work around criteria or step number 2 in revenue recognition, where we actually need to identify what those performance obligations are, right? How do we determine what is a sort of solitary performance obligation separate from others? And then we're also going to have a little bit more work around allocating the transaction price. So that's where we're going to have to decide, okay, if we have multiple performance obligations, but one price established for this contract that we have with our customer, how do we allocate the revenue to each individual performance obligation? So that's where sort of we're headed with sort of the next phase of our chapter 6 lesson.